Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Let's get you up to speed on today's market action because you can now see the Dow was actually in the green for the majority of the day. That stronger than expected jobs report really put pressure on stocks. Dow, though, just flipping positive here in the final hour of trading. Taking a look at the S&P, that is still trading to the downside, off just about 0.2%. NASDAQ 100 also in the red. When you take a look at the chart of the day, you can see that we are well off the lows of the day. NASDAQ 100 now off just about 0.6%. Russell 2000, that small cap index, is also trading to the upside along with the Dow. The Russell 2000 up just about 0.2%. Taking a look at the bond market action, 10-year yield now pulling to the downside as we see off just around 1 basis points at 352. 30-year yield, similar story there, off just about 7 basis points. Taking a look at the sector action that we are seeing today, it's a bit of a mixed picture. You can see materials, industrials, consumer staples holding on to gains this afternoon. Utilities, financials, and technology, the worst performers of the day. I also want to pull up what we're seeing play out when you take a look at the oil market. You can see crude just above $80 a barrel, off just around 1.3% today. Brent crude also under a bit of pressure, off just over 1% as well. And we want to get you up to speed with some of this action that we are seeing. Overseas European Union officials agreeing to cap Russian oil prices at $60 a barrel. That's paving the way for G7 approval. This announcement coming after days of negotiations, a last-minute push by Poland to lower that cap. The price limit will be reviewed every 2 months or so to ensure that it is 5% below the average market price. Now, G7 is expected to approve the deal with sanctions kicking in on Monday. We also have the OPEC meeting that's happening on Sunday, which can mean big moves here for the oil market. But again, crude has been under a tremendous amount of pressure when you take a look at the fact that it's just above $80 a barrel. So some of the Russian sanctions plus the OPEC meeting could mean big moves for the energy market next week, Dave.
Pivotal couple of days. We'll discuss that later in the program. As Shauna mentioned, stronger than expected jobs report. Let's get you up to speed now on today's report. The economy adding 263,000 jobs, easily topping expectations. The unemployment rate remains 3.7%, but arguably the most important number comes here. Average hourly earnings grew 5.1% from a year prior, well above the pre-pandemic pace of around 3%. One of the main contributors, of course, labor force participation, which remains below pre-pandemic levels. Payrolls grew in leisure and hospitality, healthcare, and government. For more on the November jobs report, let's bring in Betsy Stevenson, professor of public policy at the school at the University of Michigan. Nice to see you, Betsy. But for a moment, I want you to be Jerome Powell. How do you feel he viewed this report, in particular, wage growth?
Well, obviously, wage growth is worrisome here. And it's worrisome not because we don't want to see workers get raises. Of course, we want to see workers get raises. But what we want is to see wages increasing at a rate that is consistent with 2% inflation. And what's happening right now is they're increasing at a rate that's simply not consistent with that 2% inflation target. And so it does you no good if you get a raise if all the prices are going up as well. And so what we want to do is see the wage growth slow so we can see price growth slow. So he's absolutely going to be worried when he sees that uptick in wage growth. But I think it's important to realize that's not the only thing to look at in this report. It's also not the only indicator of what's happening in the labor market. And so we want to take that broader look. I know that Chair Powell and his whole team, the everybody on the FOMC and all the economists who work for them are going to take a broader look at what's going on. What we see is there are some signs of some sectors starting to slow down. And I think we'll want to see, do we actually see evidence of that in our next jobs report? This one was stronger than we would expect. For example, the tech sector in this BLS report continued on its drunken hiring spree. It's added a lot more jobs than not only where they were prior to the pandemic, but any sort of trend growth you would have expected prior to the pandemic. And yet we saw another big uptick in job growth in November over October in these information jobs, despite those stories of layoffs. It could be that the layoffs just hadn't hit the data by the time they were out there in the second week of November measuring it. It could be that, layoffs are happening on the one hand, and on the other hand, there are parts of the information sector that are continuing to expand. I definitely going to be taking, spending some time looking at that data to see, do we see slowdowns there? I think there are other sectors where, ADP reported a slowdown in a loss of jobs in manufacturing. That wouldn't surprise me at all. It was sort of what I was expecting. And yet in this report, we saw growth in manufacturing. So I think the big question is, did we sort of just get lucky and everything sort of bounced in a positive job growth way? Or is this a sign that the labor market really is hotter than some of those other indicators are suggesting?
Well, Betsy, what do you think this all means then for the Fed and the implications just in terms of policy? Because the Fed clearly wants a larger slowdown when it comes to the jobs market. They're not going to be happy even if that number is 200,000, what the estimate was for. So what do you think this means just in terms of how aggressive the Fed could potentially be because of this?
Well, first of all, I think that the Fed is not looking to see fewer people have jobs. What the Fed is looking for is to bring demand and supply into balance. And it's important to realize that labor demand is a derived demand. That the demand for workers comes from our demand for stuff, for goods and services. And what the Fed's trying to do is bring demand down so that demand and supply are in better alignment, and that'll bring down inflation. That's going to have to bring down hiring in some sectors because our demand is just sort of out of control relative to what could be supplied. And then, of course, the other aspect of labor demand they worry about is we're all trying to hire more workers, but there aren't more workers out there. So we just keep bidding wages up and up and up, and those get pushed through in inflation. And that becomes what we call wage price spiral, where it's the increases in wages, the shortages of workers that drive inflation. I don't think we've seen that happen yet, but that's the thing that they're most worried about. So let's get at what should they do? Powell is going to stick with what he said just earlier this week. They're going to raise rates 50 basis points in December. And the question for them going forward is, will they ultimately have to raise rates more than they anticipated, or will they have to hold them for longer? I think we're going to need more data coming in to be able to make that decision. The Fed is not overreacting to the great news that we got with PCE inflation slowing down, CPI inflation slowing down 1 month, and they're not going to overreact to an employment report 1 month showing hot wage growth.
Always a disconnect between Main Street and Wall Street, but try explaining to Main Street that this makes it more likely that we go into a recession early next year, does it?
Well, the fear is that the Fed has to slam the brakes on harder, meaning that what the Fed's trying to do is get us to stop consuming so much today, right? They want to raise the price of consuming today relative to tomorrow. That's what interest rates are all about. And if they have to raise interest rates further, if they have to hold them high for longer, that is going to try to keep down demand in a way that might ultimately lead the entire economy to contract. I still think it's more likely than not that we don't have a recession. And if we have a recession, it's more likely than not that it's a very mild and quick recession. But if the Fed is struggling to break the back of inflation, bringing it back towards its 2% target, it will have to go hard, deep, and long with high rates in order to get inflation down, and that increases the chance of a recession.
Betsy, in terms of the layoffs that we have seen so far, much of them coming from some of those larger tech companies that we all are very familiar with. I'm curious just from what you've been noticing, the trends that you are studying, and I know you were saying you want to dig a little bit more into these numbers, but are you starting to see any signs of layoff or signals that's coming to you that we could potentially see that in other sectors?
So we're not seeing that in this monthly jobs report. I think that's where that sort of disconnect is that there's no tech sector workers getting laid off in this jobs report. The tech sector grew in this report, and wages were on fire in the tech sector in this report, even more so than wages overall. So at the start of November, the tech sector was looking strong. We all heard as we moved through November announcements of layoffs. I'll definitely be looking to see, do we see that show up in our December jobs report that we get in January? The only sign that layoffs are really maybe picking up a little bit in the data is if we look at all the people who tell us they're unemployed and we ask them, well, how did you end up unemployed? What we see is a larger share today are saying, I ended up unemployed because I was laid off. And what's the alternative? They could have quit, or they could be a new entrant to the labor market. So we are seeing a tick up in the number and the share of the unemployed, the number of unemployed people who are saying they're unemployed because they were laid off. And we're also seeing a rise in the number of people who are continuing to receive unemployment insurance payments, which really is about a decrease in the rate at which people are finding jobs and exiting unemployment insurance. So both of those things, to me, point to the fact that there is a little bit of a slowdown underway. But you have to look hard at this report this month to see signs of it.
It's hard to make sense of some of the numbers that are coming out. Betsy Stevenson, always great to have you. Thanks so much for joining us this afternoon. Let's talk a little bit more about the layoffs that we have seen so far, specifically within that tech sector. Taking a look at some of the largest companies, Meta to Amazon, Twitter, Salesforce, all up on your screen right now, announcing thousands of job cuts in recent weeks. We talked about the fact that the IT information industry adding 19,000 jobs, though, last month. David, ZipRecruiter was out with some interesting tidbits here just in terms of job postings, the trends that they're seeing. Tech job postings down 36%, science and legal job postings off just about 30% as well. Although we're not really seeing the layoffs, like Betsy was saying, yet in some of the other industries. So it's hard to make sense of exactly what's going on here.
But it is counter the other trend, which an Oxford economist points out, that you're seeing companies hoard less skilled workers. So it is certainly not what we're seeing of the other end of the economic bracket. And I think largely you saw that screen we put up in terms of the tech layoffs. Most of those companies dramatically ramped up hiring during the pandemic. Many of those doubled their workforce over that couple of year period to deal with the rising demand during COVID. So it's a natural coming down from that mountain because we're seeing, obviously, the economy change dramatically. Yeah, but we haven't quite seen, it's a trickle, really. It's not a steady stream. It's not even a river by any means yet.
Certainly, and so different than what we've seen from past recessions, just in terms of the layoffs and the magnitude that we have yet to see. And a lot of these white collar jobs. And when you take a look at the number of job openings still in the economy, there's over 10 million job openings out there right now, far outpacing the number of available workers. So when you compare what's going on with the white collar world, at least in the tech industry, and comparing that to the frontline workers, when so many companies are still having a tough time addressing the labor shortage, it's going to be interesting to see whether the people that are unemployed, if they're going to be trading down in terms of salary, how quickly they're going to re-enter the workforce.
Yeah.
I think there's a lot of unknowns.
Well, Betsy actually in the Wall Street Journal was quoted on exactly those two phenomenons, and she said these workers should find jobs fairly quickly and fairly easily, but they will indeed have to trade down in terms of salary. So that is looking to be an impact. And it's called the Patagonia Vest recession, said a professor and podcast host, Scott Galloway. Not to make light of it, but it gives you an apt description.
An idea of at least who has been, unfortunately, facing layoffs over the last several weeks. All right, well, we are just getting started here on Yahoo Finance Live. Coming up, the National Association of Manufacturers CEO saying that the recent boom in manufacturing jobs could easily turn into a bust. He joins us to explain why. From Tesla semis to taking on Apple, it's been another wild week for Elon Musk. We'll fill you in on what you might have missed. And speaking of Musk, U.S. Senator Richard Blumenthal joining us to tell us why he has Twitter in his crosshairs. Don't go anywhere. You can see stocks well off the lows of the day. The Dow now trading in positive territory. S&P as well. We're looking at just about 0.1% gain there for the S&P. NASDAQ, though, still in the red. Well off the lows, though, of the session. Dow was off over 350 points earlier this afternoon. Joining us now, I want to bring in Jamie Cox, Harris Financial Group Managing Partner. Jamie, it's great to have you. So certainly that stronger than expected jobs report putting pressure on the markets, at least over the majority of the day. We're seeing a bit of a reversal here in the final hour or so of trading. What do you make of the action that we're seeing?
Well, this morning was your typical overreaction to data. Markets have been conditioned to think that good jobs numbers mean more and more robust interest rate hikes. And I think if you've been paying attention to Chair Powell over the last couple of weeks, that's getting ready to change. And so you see the relentless bid for duration in the 30-year Treasury, which spiked immediately after the jobs data was released and now is actually lower on the day. So what we're seeing is a good transition where, for the majority of the year, markets were caught off sides thinking that the Fed wasn't going to go as much. And now some of the markets are caught offside, not realizing the Fed is actually going to back off. So these are good things. It's actually nice to see the market kind of calm down and operate normally for once. So I'm really actually thinking that what we're seeing in the data is actually the things that soft landings are made of, where you have the inflation data really meaningfully starting to decline, and you're not seeing meaningful drop-offs in employment. So if we're lucky, we might be able to skirt recession, but at this particular point, I think the base case is recession in the back half of 2023. But maybe we'll get lucky and not have it happen that way. But the inflation data needs to cooperate to keep the Fed off the accelerator and get it to actually get to a point where they can stop raising interest rates and maybe even cut them in the early part of June or July of next year.
So then, Jamie, why are you not as concerned about the labor force participation rate not rebounding and the fact that wage growth remains high, 5.1% on this report?
So a couple of things. The first is that I think that the labor force participation rate will improve, number one. Number two, and I think it's going to be largely a pandemic-related effect that will burn off over time. So this is something that will adjust and work itself out. And we're paying a little bit too much attention to it, largely because there was such a large retirement rate wave of people over the last 18 months. That's going to stop. You're not going to see people retiring in the ways that they were then, and you'll see a normal and ordinary return to normality in the labor force participation rate. Now, the wage growth piece, I'm not so certain that we're not. If you look at the totality of wage growth and not just look at it in a short period of time, it's actually kind of nice to see that wages are up, because for the largest part of the decade they were down, and so the little bit of catch up that we've seen is actually good. So as long as it doesn't get meaningfully higher from here, it's going to be fine. There will be adjustments to the data over time that will be just fine. So I'm not worried about it. Most people are worried about it because they think it's going to turn or translate or manifest itself in a wage price spiral. That doesn't look to me like it's happening, or it has a really good chance of happening. What I think is just what you're finding is that labor was underpriced for many, many years, and you're actually seeing it being repriced to trend. And that's a good thing.
So, Jamie, there's no concern then, though, at all that this is pointing to inflationary pressures, because I think that's the main concern of the market. I guess, why are we seeing such a disconnect then?
Well, there has been a disconnect in all of the major data since the pandemic. Everything has been flipped upside down, and we're still dealing with the effects of it. And you have all this cheap labor overseas, which remains offline. I mean, if you think about all the translations and all the transition that has occurred with China still being unable to get itself back upright. When you think about what we saw pre-pandemic, you had lots of competition for labor. What you don't see that is much a phenomenon now, but it's going to get back to that place, probably not too far in the distant future. And I feel like, once that cheap labor really comes back online in earnest, you're going to see that competition re-enter and the wage growth piece sort of, like I said, work itself out. That the pandemic effects have to burn off before you actually get back to that normality. That's why you've seen such lumpiness in the data. But I think one of the things that is becoming very clear is that a lot of the pieces of the equation this year that may have made the data even more lumpy, like gas price spikes and things like that. What you're seeing in gas futures finally is you're starting to see them actually, the entire lump in the data has actually resolved itself and actually lower on the year in gas futures. So that's actually a good thing too. So some of the things that contributed to, extra problems for the inflation data is starting to work itself off. Used cars, lumber, now gasoline. These are very positive signs, and that could keep us, moving in the right direction and not avoid recession, but at least skirt the difficult forces of recession.
Quickly, Jamie, want to give some people some news they can use for the weekend. You say healthcare is the smart play given the setup you've laid out. Why?
Well, you've had a strong dollar, and in previous market conditions, we had weak dollar, strong euro, strong pound, et cetera. So when you own U.S. based companies, you had the translation, the currency that would boost your earnings. Well, the reverse is true right now. And so the sectors that, or one of the sectors, or the sector that benefits the most from that is healthcare. A full 37% of healthcare earnings are U.S. based, but the companies are largely based in Europe. So if you own those companies, they report their earnings, translate them to dollars, you get a nice translation boost there. And that has not been in play for many years. So healthcare companies are, a beneficiary of that. In addition, in every single market decline, bear market, you have a new leadership group, and that leadership group is going to be healthcare. The amount of research and development that went on throughout the pandemic, we're going to see remarkable changes in the way healthcare is delivered over the next couple of years, over the ensuing decade. And the amount of money that will be made in healthcare is remarkable. Biotech, Regeneron, AstraZeneca, you can just count one right after another. These companies are really, really fit to be the leadership group coming out of this bear market. And they weren't a bad place to hide out while you were in the bear market either, which is an unusual circumstance. So if investors are looking for good places to find opportunity, that's a good place to look.
And that's a good place to leave it for the weekend. Enjoy it, sir. Jamie Cox, appreciate you being here. Coming up, EVs were a bright spot for Ford, and its November sales report will tell you about the astonishing jump in sales. And the Justice Department wants fraud allegations at FTX to be investigated. Stay tuned for details. Ford out with lower sales in November, but the electric side of the business may be looking up. Here to break down all the details, Yahoo Finance senior autos reporter Praz Subramanian. All right, so what's the deal? Ford had a tough month, but in terms of the future, you could argue looking up, EV's the future.
Yeah, surprisingly, Ford's overall sales down 7.9% in November. But electric sales up over 100%. Ford says they now command 8.6% market share in the EV space, which is pretty strong. The Lightning pickup sold 2,000 pickups last month, about 13,200 overall this year since May. The Mustang Mach-E, 14.6% up versus last year. And now they say they've sold or created 150,000 Mustang Mach-E since the beginning of that car production run. So again, pretty strong. And the F-Series still going strong. They predict the F-Series will be once again the top selling truck in America. But lastly, yeah, Dave, it's really interesting that they have these lower November numbers for Ford. In Q3 they said they had 40,000 vehicles that still needed parts to be shipped out, and that would happen in Q4. So potentially, maybe we might see a little bounce in December. But Ford said to me that it's not because of part shortages right now, and they wouldn't say
it's demand.
It's possibly demand. It's better offerings from Hyundai and Kia, things like that. So I'm not exactly sure. We'll see what happens in December, which is usually a big month for auto sales.
I think you just put your finger on it. Hyundai and Kia both had record numbers in November, so perhaps that is the reason. Proud to be remaining and enjoy the weekend, sir. Sorry to be so brief. Thank you.
All right, well, the Justice Department is requesting an independent investigation into the collapse of FTX. Yahoo Finance's David Hollerith is here with the details. And David, what can you tell us about this and the significance of it?
Yeah, well, so as far as significance goes, this was filed yesterday by the U.S. trustee, a component of the Justice Department. And the same thing happened months ago in the bankruptcy case for Celsius Network. At a high level, this would be something like a forensic analysis that would be used to determine the root causes that ultimately led to FTX's collapse. It would also involve tracing where funds or assets have gone, and that could implicate, how creditors are paid out and in what order. And the examiner's investigation, which is what is being asked for, an independent investigation, would likely be appointed by a law firm to some extent. Now, the motion hasn't been approved yet by the judge, but it is likely to do so given the stakes that have already been raised in this bankruptcy. And the nature of complications. The U.S. trustee, again, in the court document filing this motion, citing also too that there is substantial basis to believe that management of FTX conducted fraudulent activities and otherwise did not keep the books correctly. So the demands for this seem fairly normal, and we're likely to see a ruling on this soon, although it might take a hearing to decide it.
Well, speaking of the hearing, that's what we expect in the House Financial Services Committee. What's the expectation there?
Yeah, that's right. So the last time Sam Bankman-Fried testified before the House Financial Services Committee, Chairman Maxine Waters blew the young crypto mogul a kiss afterwards. Bankman-Fried has been invited back again, obviously, and we're not really expecting that this time. It's likely to be different. Waters has invited the FTX founder to testify on a panel December 13th, which will be about the exchange's collapse. She and the Representative Brad Sherman have also said that he could attend virtually if preferred. Now, Bankman-Fried has not responded yet to the request. As for what can be expected from the hearing, outside of more details on how FTX lost an estimated $8 billion of customer funds, we're likely also to hopefully hear something about the investments that Bankman-Fried had said came in just after the company had filed for bankruptcy, and hopefully more clarity onto the risk management practices FTX had been conducting.
All right, we'll see if Mr. SBF gets on that tie again and comes to Capitol Hill. Don't hold your breath. David Hollerith, thank you, sir. Enjoy the weekend. Coming up, DoorDash shares trading lower today, and we'll tell you why an analyst downgraded the stock after the break.
time for a triple play. 3 stocks that we are watching here in the final 25 minutes of trading. We have DoorDash, Boeing, and Cracker Barrel. So let's kick it off with my pick, and that's DoorDash. The stock falling today. You can see it off just about 2% on a downgrade from RBC. Now the firm lowering its rating on the stock to sector perform from outperform on increased competition, also slower growth that they think could continue here in the coming quarters. The RBC writing in a note to clients that the risks are, quote, too important to ignore. Earlier this week, DoorDash announcing plans to eliminate about 1,250 jobs or 7% of its workforce in an effort to cut costs. We're looking at a chart. Year-to-date chart, a very different story. I guess for the 1 month, we're in the green, but year-to-date under a severe amount of pressure. Jared, obviously the company looking to cut costs here. Competition, though, like RBC noted, really mounting, and they specifically called out Uber there as a huge competitor going forward.
Yeah, you got to wonder, is Uber kicking itself for not getting out of this business years ago? Because it almost did. But I'm looking at the Wi-Fi Interactive real quick here. I'm showing the 1 month returns, and you'll notice that it's delivery services that are mainly in the green. Uber, Hertz, Lyft, those are all in the red, as is Avis Budget Group there. But I want to move on here because my play is Boeing, and the stock is climbing to its highest level since April. Let me pull up our industrials map. There we go. And here's Boeing up 24% for the month, and I'm going to dial this down to a 2-year chart. The plane giant is nearing a deal with United Airlines to buy dozens of 787 Dreamliners. No parties are commenting on the record, but Boeing competitor Airbus reportedly in the running for some of the orders. The Dreamliner sports a $300 million price tag. It's noted for its fuel efficiency and ability to make long-haul routes in a single stop without the need to refuel. And the deal, if it goes through, would be a major win for Boeing, which has been beset by setbacks since those 2 737 MAX planes crashed in 2018 and 2019. This is a 2-year chart. Just want to show you this chart right here is showing a breakout, very nascent breakout on a longer term basis. Could mean something. When you take a look at the other industrial companies here over the last month, Boeing is actually one of the big leaders. I got some materials companies thrown in there too, but if readers will remember, or viewers will remember all the way back to 2017, this was the stock market in 2017. Of course, that was in the past, not so much anymore.
Very interesting to watch them against their competition. Boeing had dominated that category that the Dreamliner plays in, so it's a big win against them, but they've taken very different paths to the same place, which is both down 12% year to date in a year where travel truly has bounced back to pre-pandemic levels. All right, my play is Cracker Barrel. The stock slumping to finish the week on missed expectations. Net income dropping to $17 million or 77 cents a share, from $33 million or $1.41 a share from a year prior. Pretty precipitous drop there. For fiscal 23, the company also trimmed its revenue growth outlook. CEO Sandra Cochran saying, quote, while the increased macroeconomic uncertainty and persistent inflationary pressures merit caution, we believe our value proposition and strong guest experience position us well to navigate the environment. Shares hammered, as you can see, down more than 12% today and 24% this year. And you continue to hear CEOs like Sandra Cochran talk about this macroeconomic environment that is softening and what they're seeing from the consumer, another good indicator of what could be around the corner.
Yeah, and just another example of inflation hitting some of these companies here. They expect commodity inflation to be at 8 to 9% growth in 2023, wage inflation up to another 6% next year. So certainly higher prices, a huge headwind for Cracker Barrel and also for many of its competitors as well, because they're being forced to pass along some of those higher prices to consumers.
You've been to Cracker Barrel? I was just going to guess you hadn't.
No, I have. I have. They have a very, very good breakfast. Have you?
I have many times, but I lived
on
in
the way to
Oklahoma,
Disney World when I was a kid, many times.
It's good.
Chicken
it's
fried
good.
steak is
I've
also
gone with my mom
terrific.
a couple times. I like it a lot. All right, well, coming up next here on Yahoo Finance, the head of the National Association of Manufacturers giving us his take on lawmakers stepping in to stave off a rail strike. We've got that for you next. Manufacturing openings climbing in November. The sector adding 14,000 workers in the month of November alone. There is, though, a huge challenge that's facing the industry, and that's filling the more than 700,000 openings. So joining us now, talk a little bit more about that and some of the other data that we've gotten out this week. We want to bring in Jay Timmons, National Association of Manufacturers CEO and President. Jay, it's great to have you on the program. Great to have you here in studio today.
Nice to be here in person instead of on video.
I know. It's great here. So Jay, let's talk about that piece of data that we got out this morning, 14,000 jobs added to the manufacturing sector. We also got the ISM Manufacturing Index yesterday showing a bit of a cooling there, pulling back contracting for the first time since 2020. I guess just your takeaway from what we have seen play out over the last several months.
The good news, bad news, good news, bad news thing.
Yeah, exactly. It's hard to make sense of everything that's going on.
So the good news is we have added more jobs in the last 2 years than at any time. So in 21 and 22, we've added more jobs in those 2 years than have been added since the Reagan administration, 83 and 84. So that's an amazing amount of job growth. At the same time, as you mentioned, we have hundreds of thousands of jobs we can't fill. The monthly average is 830,000 jobs that we can't fill. That number will grow to 2 million unfilled jobs by the year 2030 if we don't get it under control. So that's the good news, bad news on the jobs front. Now on the kind of the health of the sector, cooling down a bit is one way to put it. I'd say the water's tepid right now. And that number is just right under 50, so technically it means a contraction, but it's really close.
So you're not too worried just about what that could potentially signal in terms of a recession?
I think what's happened, you think about the trillions of dollars we pumped into the economy during the pandemic, and that money had to wash its way out of the system. And when it was doing that, there was this tremendous demand for our products, and we had little supply. One of the reasons we had less supply than necessary was we didn't have the people to make the products. So I think that that's now catching up. We were able to start ramping up production. So now I think there's a bit of, the inventories are a bit full right now, but that'll come, wash its way out.
And Jay, when we talk about the huge challenge facing the sector, more than 700,000 job openings, I know something you and I have talked about in the past. When you see it on a larger scale, though, there's over 10 million job openings right now in the economy. How long is it going to take to close that gap? And I guess, what's the best pathway forward in order to do that?
Wow. How long do we have?
Yeah.
Because there are so many potential solutions, and there is really no one magic bullet. But what I do know that we need to do is we need to get serious about immigration reform.
And how would that help?
That's a piece. So H-2A, H-2B, bringing those folks in temporary protected status into the workforce. We have 100,000 Ukrainians we invited here. We have 100,000 Afghanis that we invited here, but we don't give them the ability to work. We don't give them a work permit. They're in line waiting to get that work permit. That's just crazy. We have 200,000 people that could work today if we could just get through the bureaucracy, cut through all that. So that's just one piece of the puzzle. The other piece of the puzzle, I think, will help correct itself. There's a lot of folks that are kind of sitting on the sidelines right now because during the pandemic, it was people reprioritized their lives. And I think a lot of people said, I'm going to wait and see what I want to do. So for us, we say, hey, look at manufacturing, because if you want excitement and a rewarding career for the rest of your working life, you need to come look at manufacturing. So part of our challenge, you talk about 10 million open jobs, is we're now competing. We weren't doing this before the pandemic. We had open jobs and we wanted to figure out how to change the perception of our industry. Today, we're competing against every other sector of the economy to try to encourage people to come into manufacturing.
And Jay, going back to that first point there, immigration reform, and the conversations that you've had, especially who you've been talking to on Capitol Hill, are you confident that we will see some sort of progress there?
I'm confident that if we focus on the economy and we put aside kind of the extreme positions on both sides of this issue, and we simply say, okay, what do we need to do piecemeal to improve our economy or to protect our economy from the fact that we don't have enough workers, I think we can get pieces of immigration reform done. Is it going to be everything? No, it's not. But I do think that, there's not one member of Congress or the Senate I've talked to who says, you know what, just as a matter of principle, I'm going to let the American economy tank. That's not good for anybody.
Yeah.
So I do believe there is a path forward, and we're working pretty hard to see that happen with quiet discussions with members of Congress.
Jay, another big piece of news this week, President Biden this morning actually signing the legislation to avert a rail strike. We obviously know that the potential, the devastating effect that could have had on the economy. Just your take on what was actually signed and the fact that the paid sick leave was not included in that.
So look, kudos to the president and to Secretary Walsh and to Secretary Buttigieg, to Republicans and Democrats in the House and the Senate that realized this could have been crippling to the economy during the holiday season if we had a rail strike. This is a procedure that has been enacted 18 times in the last 100 years, so there's precedent for it. It is, from everything I've seen, I don't represent that particular specifically that segment of the economy, but it looks like a pretty good package. I mean, there's up to 5 weeks of leave on average for rail workers when you include sick and vacation and personal leave. I think a couple of negotiations ago, the union wanted to put all of those into one basket and not label it one way or the other. So it was a little surprising to me to see now they wanted to carve out a sick leave category. I think these are discussions that have to occur between management and the union because, look, we all know that we rely on our teams. We want our teams to be happy and productive. And I happen to know the CEOs of the major rail lines, and I know they want their teams to be fulfilled and happy. So I'm sure these discussions will continue.
Yeah. All right. Well, Jay Timmons, great to have you in the studio. Thanks so much for taking the time to join us this afternoon.
Thank you. It's great to be here.
And we hope to have you back in New York City again soon.
I hope to be here.
All right. Have a great weekend there, Jay. Coming up next year on Yahoo Finance, Kanye West's Twitter suspension put an exclamation point on Elon Musk's very busy week. We'll recap his week that was next.
A picture is worth 1,000 words, and in the case of the world's richest man, $100 billion in net worth. This picture here, that is the bedside table of Elon Musk and how much he's lost this year on paper. On that table, 2 guns, 4 caffeine-free Diet Cokes, a painting of George Washington crossing the Delaware, a Buddhist ritual object, and a book, which I'll address later. It's frankly a mess, but a perfect illustration of Elon's business priorities. They are scattered, to say the least. He started the week by taking on the biggest company in the world, asking his 119 million followers if Apple, quote, hates free speech in America. A midweek trip to Cupertino and the combination of Apple's peaceful pond and Tim Cook's calming demeanor seemed to smooth things over for now. Elon then sprinkled in an update on SpaceX and, quote, more progress to Mars. And at the complete opposite end of the earth, or actually down in it, he was criticized by the Wall Street Journal for ghosting cities across the country with ambitious, unfulfilled promises of traffic-altering tunnels from his boring company. And Thursday, folks, was truly bananas.
He's not actually using a keyboard. He's moving the cursor with his mind to the highlighted key. It's also important to show that Sake actually likes doing the demo and is not like strapped to the chair or anything.
He being the monkey. His Neuralink demo showed a monkey control a cursor and type on a computer using a brain implant. Elon adding human trials are 6 months away. No word from the FDA, but remember, the Cybertruck has been pushed back 3 times and still no indication when we're going to see it. He did, however, deliver an even bigger truck last night.
If you're a truck driver and you want the most badass rig on the road, this is it.
That was very low-key, Elon. Must have been thrilled at those Diet Cokes in the nightstand, Pepsi I'm talking about, because they received the first EV semi, which Tesla says has completed a 500-mile drive on a single charge with 80,000 pounds of cargo. The end of the week brings us back to that book on the nightstand. It's up there in the corner, behind the water bottle. The sleuths on the internet determined that was Washington's Rules of Civility and Decent Behavior in Company and Conversation. Kanye West apparently did not read that book. He has been banned from Twitter for more anti-Semitic material. And according to the internet sleuths, neither gun is real. One is used in video games, which begs the question, how much of this act is real? How much is for show? I'm not going to give the richest man in the world advice. I'll read a quote often attributed to the most influential businessman of our time, Steve Jobs, to give Elon some advice. Do not try to do everything. Do one thing well, Shauna. That is terrific advice from Mr. Jobs, who, of course, founded Apple. And one piece of advice that Elon could probably follow in focusing on Tesla.
Yeah, it certainly is a piece of advice that he could follow that I think many would argue he should follow. I don't think many people are confident that he is going to follow that advice. I don't think he has an ability to focus on one company. I mean, listen, Elon Musk is a brilliant man. I don't think many people would dispute that. But I think he has his hands in so many things. When does he sleep? How does he have time for all of this? And I think Tesla's stock performance has reflected some of those concerns recently. When you take a look at the losses, more and more analysts coming out on the street saying that Twitter is a huge distraction. It's now a risk here for Tesla investors, something that doesn't seem to be going away anytime soon. So you're looking at two companies, just 2 of them, Twitter and Tesla, that are facing major changes or growth opportunities, at least when it comes to Tesla. It's hard to imagine how he is going to be able to balance all of this going forward. We know he loves to be in the spotlight. I don't think anyone would dispute that, but clearly it's a little hard to see the direction of all of his endeavors at this point.
Well, and what is clear is this Twitter endeavor truly excites him because he engages in it 24 hours a day, 7 days a week. It's clearly his passion, and that's what really gets him up in the morning, and he's often tweeting at 4 in the morning, which tells you what he's passionate about. And to your point about Tesla having lost more than half its net worth over the last year. But I did agree with one thing he said on Twitter today. And he said that Twitter is being fair when extremists on the far right and the far left are simultaneously upset. Twitter aims to serve the center 80% of people. I hope he's right.
I hope he is
If
right.
in fact he's right and he gets this right, then he brings it all back and he can focus on making society a better place. But
We'll
we
see.
shall see. Coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live.
About a minute away from the close, Ines Frey is here with a closer look at today's action. Hey, Ines.
Hey, Shauna, and we are going to end off the lows of this session with the Dow possibly in the green. Let's see what happens in the next minute of trading. Up 41 points for the Dow, the Nasdaq Composite down 0.1%, and the S&P 500 relatively flat after that hotter than expected jobs report this morning. Much of this also has to do with the U.S. dollar index, which had spiked higher earlier this morning after that jobs report. It has since come down a bit. So that has been giving some support to equities. Over on the sectors, you've got technology, which is underperforming, but materials and industrials in green territory. And over on the NASDAQ 100, you can see a mixed picture. The big winners for the week, though, being the Chinese ADRs. It's the closing bell.
Time for the weekend. Almost. There's your closing bell on Wall Street. Let's check out how those markets finished up and look at the Dow finishing up 33 points. The S&P 500 down just slightly, basically even, as is the NASDAQ for the day. All of it reacting to that hotter than expected jobs report once again. Let's break it down with Joanne Feeney, partner and portfolio manager at Advisors Capital Management, and Kathy Jones, Charles Schwab, chief fixed income strategist. Nice to see you both. And let's go ahead and start with you, Kathy. Your reaction to the market's reaction to that jobs report that just won't cool down.
Yeah, it's very interesting because early in the day, it looked like the market was going to react adversely to it on the idea that maybe the Fed has to raise rates more than expected because the job market is continuing to be pretty firm. and wages were up a bit more than expected. But now we've kind of come all the way back, and I think that the assessment is probably that this doesn't change the trajectory. We know that the Fed is still on track to raise rates a bit more, but this is maybe not bad enough to change the terminal rate or the peak in the Fed funds rate or make them more aggressive going forward. So here we are sort of back to where we were yesterday, waiting for the jobs report that wasn't a big decisive factor.
What do you think, Joanne? Do you agree just in terms of the fact that the Fed won't change its course or really more so be more aggressive and have a 75 basis point hike back on the table this month?
Yeah, the Fed's pretty clear that they're paying a lot of attention to this data. I think the really surprising thing this morning was the increase in wages. That came in, higher than expected. We have an issue in this economy that we have a labor shortage. So it's making it really hard for the Fed to get the wage side of the inflation equation under control. And so the data that came out today just confirmed that there's a shortage out there. Firms are still hiring, and wage pressure is still out there. They do see, though, some reasons for inflation to cool down. It looks like we have hit peak inflation, and they've made it clear that they're going to continue to raise rates. I don't think we're going to see 75 basis points this month, and they're going to do smaller rate increases. They made that very clear, but they're going to continue to do them and then probably hold for a while once they reach a rate they think is sufficiently contractionary. And we're seeing that in the real interest rate, that's moved enormously this year, and that really does constrain financial activity.
But Kathy, doesn't this labor market, doesn't that wage growth, 5.1%, mean that Jerome Powell has more work to do?
Yeah, I think the Fed's been very clear on what their plan is. So hike enough to be in restrictive territory to slow the economy. That's probably 5% or so on the Fed funds rate. Seems reasonable to us. Hold for a while to assess what happens, to see the lagged impact of all the tightening that's taken place to date, and then adjust when the time comes when the data tells them to. So I wouldn't make too much out of just 1 month's wage data. It was above expectations. We've been waiting for it to roll over. I think the Fed would be a lot happier with 2.5% to 3% wage growth. But keep in mind that there's a lot of kind of technical factors in there. We had a big boost in a couple of categories that tend to be higher paid. We're getting into severance payments for tech workers that may have affected the numbers. The overall picture on wages is that they're rolling over. And the overall picture for the consumer is that a lot of the fiscal stimulus has worked its way out. And the overall story is the Fed's done a whole lot of tightening over the past 8 to 10 months. That's probably just now beginning to work its way into the system. So I would argue that the trend in inflation next year will continue to be lower and that the wage growth will slow down as well.
Joanne, where do you stand just on the risk of a recession? If you think we're going to see one, is this something we should be worrying about for the first half of next year or more likely to happen in the second half?
Well, the risk of recession clearly has gone up. But the thing that makes it potentially hard to forecast in this kind of a rising rate environment is that we do have this labor shortage. And we're seeing, in fact, firms hoard labor. We're not seeing the level of layoffs and quits that we've typically seen historically. And so that suggests that a classic recession where you have a big spike in unemployment is less likely than a mild recession where you see more of a sharp decline in job openings, wage growth coming back down to a normal level, and certainly softening in consumer spending. We're already seeing saving rates decline. We're seeing households dip into their past savings. But, so we're looking at next year as more of a potential mild recession, unemployment going up, job openings really coming off the boil, and the slower consumer spending. And that's, I think, a decent way to think about how to invest. But one positive is that the rate increases that are behind us are much bigger than the rate increases ahead of us. And so those headwinds for growthier stocks are likely to peter out and eventually reverse into tailwinds. And so that does set up not a terrible investing environment going forward if you can look out 2 or 3 years for the ultimate payoff.
And Kathy, given that setup, what's your advice to investors?
Well, I focus on the fixed income markets, and we've been saying for quite some time that investors should be taking advantage of these yields by extending duration in high quality bonds. I don't think we're in a new world of high inflation that's going to continue to accelerate for a long period of time. And real rates are high. And so that's the time when you want to start extending duration, moving into intermediate and longer term bonds to capture that income that's available now. And we've had a huge increase in rates since the beginning of the year. Income from bonds right now, investment grade corporate bonds, after tax adjustment for municipal bonds, even treasuries, 4 or 5% plus. And with very low risk, not that much duration risk, makes a lot more sense to us than taking risk in some of the other parts of the market. So that's a viable alternative to, say, dividend-paying stocks and other assets that are still going to be much more sensitive to the cyclical environment and the economy. So we're definitely in favor of high credit quality, intermediate to longer term duration bonds for investors to balance out their portfolios.
All right, Kathy Jones, Joanne Feeney, thanks so much for joining us this afternoon. Have a good weekend. All right, coming up next, oil down more than 30% over the last 6 months. Energy expert Daniel Yergin is here to tell us where he thinks prices could be headed next. The EU agreeing to set a price cap on Russian oil exports at $60 a barrel. Diving into the details of this, the agreement allows for price revisions every 2 months to keep the cap at 5% below the market price. Joining us now for more on this and some of the other big stories that will likely affect the energy markets here in the coming weeks, we want to bring in Daniel Yergin, S&P Global Vice Chairman, and also the new map, Energy, Climate, and the Clash of Nations author. Daniel, it's great to have you. So let's first start with the big news of the day, that $60 price cap on Russian oil. Your reaction to this, and also what you think how Russia could potentially react to this news.
Well, I think it's not surprising that it's $60. It was being talked about around $65. The polls were arguing for $30, and I think 60. It's kind of where it's expected to come out. Russia has indicated that it wants no part of this. It doesn't want the U.S. Treasury setting the price of its oil. And the Russians have talked about cutting supplies, in which case, in a way, that would be like what they've done in Europe with natural gas. And they may do that, or they may decide at 60, that's kind of what they're earning anyway. But, they say they want no part of it. And so there's a lot of, sleight of hand here to make this work, that the Russians will say that the oil wasn't sold under a price cap, but it was. And I think people in the market are still pretty confused or uncertain. How is this thing actually going to work? Monday is a historic day when this goes into effect.
Will it have any impact, Daniel?
Well, it could. Yeah, there are two impacts. One, if it actually works, I think it probably has a kind of gravitational pull on the price down. By the way, that's why the OPEC nations don't like it, because they say, well, wait, if the industrial nations are setting the price on Russian oil, someday will they set the price on all of our oil? So you have OPEC plus versus the sort of the G7. But if Russia does do what they've threatened to do, to take 1 million or 2 million barrels a day out of the market, then you'll see a very different price reaction. The one reason they might not do it is because that can hit China and India, which are their friends right now when it comes to oil.
Daniel, you mentioned OPEC. Let's talk about it, because the meeting happening on Sunday, lots of anticipation just in terms of what could potentially come out of the meeting. Are you expecting anything significant?
The mainly significant thing that I'm expecting to come out is nothing of significance. It was pretty bruising, that last OPEC plus. And I was in Saudi Arabia a couple of weeks ago, and I could see the tension palpable between the U.S. and Saudi Arabia over that. I think at this point, especially with the uncertainty of what happens on Monday, which is both the price cap and, of course, the ban on the import of seaborne Russian crude into Europe, I think that despite the fact that we've heard that the Russians would like a cut in volume right now, that the course that OPEC Plus probably will do is have a phone call and do nothing.
And the following day, the EU ban on Russian oil kicks in. And the same question, what's the impact of those?
Well, what's happened is that Vladimir Putin has basically destroyed his most important market for his oil and gas and his coal, which is Europe, because basically they don't want any part of it. Right now, coal is gas is a big problem, particularly as it gets colder. But I think the Europeans have, the reason partly that this whole price cap came up is because the U.S. looked at the ban that the Europeans were going to do, which is not only the import of oil, but also on shipping and insurance services, and said, holy cow, there's going to be a shortage in the world market, and that will create panic. So let's create this price cap as a mechanism, keep the oil flowing, try and reduce Putin's revenues. But I think come Monday, oil that was already contracted will flow in. It's going to be a different market. And the thing to watch is in February, when the same prohibition goes on Russian products, because diesel and products like that are a really tight supply, and the impact might even be more serious.
Daniel, let's talk about the impact that we could potentially see here in the U.S., if any, because crude prices have been under pressure over the last several months. They did, though, end the week to the upside. In terms of what you're expecting to see, crude right around $80 a barrel, do you think we'll likely hover here or head higher in the near future?
Well, I think, I've never seen a time before where the price of oil depends on the infection rate of a disease, which is the case of China. And you see the price actually going up or down depending on whether China is opening up or not opening up. I think Xi Jinping's government has kind of waken up. They have a problem with these kind of lockdowns, and they're trying to back off from them and get the local people not to be so stringent. And the big hit in the oil market is you're probably missing 700,000 barrels a day of Chinese oil demand. So if China does begin to open up, we'll see the oil price respond on the upside.
The price of gas, astonishingly here, is now below the start of the Ukraine war. How do you account for that?
Well, I think it's really the price of crude coming down is what it was. And remember, before the war began, the energy crisis actually began 6 months before the war. The first release that the Biden administration made out of the Strategic Petroleum Reserve was in November, 3 months before the war. So before the war began, we already had a pretty tight global oil market because of this problem of pervasive underinvestment in new supplies.
Daniel, just in terms of your prediction for gas prices then going forward, as Dave was saying, we certainly have seen a massive move to the downside. We know we're going into what is seasonably not exactly the most, I guess, active driving season. Are you confident prices will hover around where they are today?
No, I'm not confident. I think if we see China come back into the market, it will change. And I think Monday is a historic day. And it could be very, some people say this will all work smoothly, but it could be very turbulent and reflected in prices. And you're really predicting, among other things, what is Vladimir Putin going to do? He's already made, obviously a lot of miscalculations. He can do it again. So in a way, if you think about what happens in the oil market in the next few weeks, a lot depends on the decision making by one Vladimir Putin and one Xi Jinping.
Vladimir Putin, arguably the most unpredictable world leader on the planet. Daniel Jurgen, good to see you, sir. Enjoy the weekend. Commodity prices for food staples are dropping, returning to 2021 levels, but grocery prices are not budging. Yahoo Finance's Inez Ferre here to tell us why. Inez.
Yeah, Dave. And as you mentioned, agricultural commodities, those are down from what we saw those levels after the Russian invasion of Ukraine. Take a look at wheat futures. You will see a year to date here. Wheat futures relatively flat for the year. Oat futures are down 47% year to date. Even coffee futures are lower year to date, down 27%. So what is happening here? Because people are not seeing these lower prices in commodities translate to their grocery bills. You've got food inflation that is up roughly 12% year over year. Well, food producers, they're hesitant to lower their prices because of uncertainty when it comes to grain. Often that output grains are planted for the following year. So there's been a lot of turmoil with the situation with Ukraine. Also, the energy prices, those are still relatively high, even though they have come off their highs. But energy is a big factor when it comes to food, especially when you're talking about farmers planting. They use diesel, and diesel has not come off its prices as much as gasoline has from their highs from earlier this year. Farmers use diesel, and also transportation is in diesel as well. So a lot of this takes about 3 to 6 months to translate into grocery bills. I did speak to a produce producer who was telling me that the prices at shipping points, those are down, but that doesn't reflect on the wholesale prices or supermarket prices also, because that takes time. There's a lag there as well, because you also have inventory at supermarkets that you need to clear out first before you bring in those other products, guys.
Could be a while till we see some relief, right? Inez Ferre, thanks so much. Well, coming up next, fans of Indiana Jones and Marvel superheroes have plenty to look forward to next year. We've got the details for you after the break.
Following years of big bank bonuses, a lump of coal might be coming their way this Christmas. JP Morgan Chase, Bank of America, and Citigroup planning to cut investment banker bonuses by as much as 30%, according to Bloomberg. Some plan to forgo bonuses entirely for low performers. The reason, of course, investment banking revenue decimated, nearly cut in half at the 5 biggest U.S. banks, a decline of $18.8 billion in the first 9 months of the year. The report suggests more than 100 Goldman investment bankers could be, as they say, zeroed out, get a goose egg, donut, or even a bagel. Yeah, Shauna, of course, there's slang for getting zero bonuses, a thing journalists have been accustomed to for our entire careers.
That must be nice. But I do think, though, this is part of a larger trend just in terms of, I don't think it's a big surprise that bonuses are falling. If they weren't falling, I think that would be a huge story given the fact that we've seen such a decline in their business over the last 12 months. What will be interesting going forward, bringing it back to jobs, is the potential layoffs that we could see within the sector. We know many of these banks typically have annual layoffs at the end of the year where they cut X amount of their lowest performers, their underperformers. That has largely been suspended over the last 2 years. A couple of banks have said that they will be reinstating that this year. A couple have said, or there are reports like Bank of America could be reinstating that next year. But in terms of the layoffs, haven't really hit this sector hard in terms of comparing it to how we've seen in prior slowdowns and in recession. So I think that's the next shoe to drop in this sector, is whether or not we will see more layoffs in 2023.
And if I could spin that forward as well, curious if the economic impact of those lesser bonuses, that's certainly money that gets put out there in the economy around the holiday season. And beyond that, the IPO market. The IPO market has been devastated. It has been ghost town. Think how much press was dedicated to the Porsche IPO, down 93% IPO activity from 2021. Will that rebound next year? And if so, banker bonuses certainly will.
Yeah, we will see. All right, well, turning to the latest on the Disney-DeSantis feud, Florida Governor Ron DeSantis denying reports that state lawmakers are backtracking on their fight to strip the theme park of its special tax district. Yahoo Finance's Alexandra Canal is here with the details. Ali, we've been following this story for quite some time now. DeSantis disputing this report, but what can you tell us?
Yeah, he said it on Tucker Carlson on Tuesday. He said Disney ultimately brought this on itself. And then in a statement provided to NBC News, he said there will be no U-turns on this decision. Now, to just back this up, for those that don't know what the Reedy Creek District is, it basically allows Disney to operate as a self-governing entity. So it prevents them from paying certain taxes. They don't have to follow certain regulation. And sources that I've spoken with have said it's basically like a Vatican with mouse here. So that's one way to think about it. Now, DeSantis stripping this right from Disney, it could have implications to the citizens in the surrounding counties, Orange County, Osceola County, because Reedy Creek has nearly $1 billion worth of bond debt, some $163 million in annual tax payments, and that throws those payments into question. Ultimately, who is going to pay for this? So it's this push and pull with lawmakers and then also Disney. Now, Bob Iger was asked about this during the town hall. He said he's still looking into this, into what could come of it, but that ultimately Florida is very important to Disney. Disney is very important to Florida. And again, this all has to do with that controversial Don't Say Gay bill that went into effect on July 1st. And if this bill is not reversed, it's going to go into effect in June of 2023. And the financial consequences of that for Disney as a business is unknown.
And it's not entirely clear if Iger would have played that differently at all, but we do know he has that deft touch that is legendary, that maybe he can smooth that over, because ultimately Florida residents may be hurt by taking away that tax privilege. But still on Disney, The Hollywood Reporter with some intriguing M&A activity, some far-fetched proposals. Are any of them possible?
Some of them are possible. I think majority are not. You know, The Hollywood Reporter laid out, could Disney sell to Apple? Iger said that's pure speculation. In terms of the Netflix acquisition, to me, Disney and Netflix are the leaders in this space. I think if we're going to see any streaming M&A in 2023, it's going to be from those smaller players, maybe Paramount and NBC Universal. Now, this is interesting with the Roblox Epic Games acquisition. Remember that Disney did wade into the world of gaming. Under Iger's leadership, they tried some in-house gaming, but it was an epic fail. So I don't think Iger will want to revisit that during his short theoretical 2-year tenure at the company. But in terms of the future of Hulu, this is going to be the biggest one because of the timeline. Disney is currently on track by 2024 to buy out Comcast's 33% stake in the company, and that would value the streamer at $27.5 billion. Now, a lot of investors on the street are actually saying that Disney should sell this because it can contribute to a very high bidding war. Disney is desperate for cash right now. And again, because of that 2-year timeline for Iger, that's something that he will probably have to figure out. And then when it comes to the ESPN spinoff, that's up in the air. Sports is expensive, but it also drives a lot of profitability for Disney.
I watched an interview with Jimmy Pitaro this week, and it is clear they are simpatico. Bob Iger and Jimmy Pitaro are tight. They talk almost daily. They talk sometimes just about sports. Iger hired Pitaro. I think they're pretty locked in.
The brand, the
right
ESPN
now.
brand is just
huge.
iconic.
And yeah, so valuable there to the company. Ali, let's talk about some of the upcoming movies that we have for next year in terms of potential bright spots here for Disney in the 12 months.
Yeah, in 2023, we're entering phase 5 of the MCU. That means we have an Ant-Man sequel. We have Guardians of the Galaxy Volume 3, The Marvels. And then outside of the MCU, there's a live-action Little Mermaid, Indiana Jones 5 with Harrison Ford. So a lot to look forward to in 2023. And of course, at the end of 2022 with the Avatar sequel coming out. That is a Disney-owned property with 20th Century Studios. So theater is certainly happy with Disney through the end of this year and into 2023.
We'll see if it gets people back.
I love Paul Rudd. He's just
Me too, actually. I'll give you that. I thought I was going to disagree with what was about to come out of your mouth, but I
You
agree.
love Paul Rudd. There's something wrong with you. Ali Canal,
Agreed.
thank you. Enjoy the weekend. Coming up, U.S. Senator Richard Blumenthal has called on the Justice Department to hold Ticketmaster accountable after Taylor Swift ticketing disaster. He tells me what he wants to see happen next. President Biden signing a bill into law today avoiding a national rail strike and what he says would have been an economic catastrophe. One of the 15 no votes came from Republican Senator Pat Toomey, who said this morning, the more Congress gets involved in settling these issues, the more ridiculous the outcome. Joining us now to discuss this, Senator Richard Blumenthal from the great state of Connecticut. I'm not biased, I live there. Senator, nice to see you. Your reaction to how this played out, Congress, and is Senator Toomey right that Congress should not be involved in settling issues like rail strikes?
My strong preference was to avoid any involvement in this rail situation. And I think my view was shared by the vast majority of my colleagues. But obviously the looming catastrophe, and it really was a catastrophe, prompted us to take this action. And going forward, I think we need to make sure that railroad workers have paid sick leave. I think that working conditions there need to be improved. We're not letting this issue go. And I would have been very much more reluctant to intervene had we not faced $2 billion a day, literally $2 billion a day in losses, and potentially even longer range impacts to the American economy, and issues as simple as purifying our water, delivering chlorine so that water systems could function. The supply chain issues that were raised, the longer term impact, I think were the reason that we became involved.
Certainly a happy ending there, at least for this economy, maybe not for those labor unions. The other story consuming the business world this week, Sam Bankman-Fried and the show he's put on attempting to explain the collapse of FTX. Are you buying his explanation that he didn't try to commit fraud nor knowingly commingle funds?
David, I'm really a prosecutor by career. I served as the U.S. Attorney in Connecticut for 4.5 years, the chief federal prosecutor, and then I was Attorney General of our state for 20 years. And I can tell you all the evidence, all the signs are there of real fraud, just plain dishonest dealings. And whatever he may say he intended, the circumstantial evidence points to his knowing what he was doing when he moved funds, when he took advantage of his position of control. And so I think the Department of Justice ought to come down on him like a ton of bricks if the evidence is what we think it is now. Obviously, we have to say at this point there are allegations, but there is a lot of evidence there of real fraud. I'm tempted to say garden variety fraud. You can call it crypto. You can say it's novel in that the magnitude of the losses in cryptocurrency are unprecedented, but essentially it seems like real garden variety fraud at a massive level in a new setting. And I think the Department of Justice and other regulatory agencies should be enforcing the law. And I think Congress has to look at stronger oversight and scrutiny as well as regulation when it comes to cryptocurrency.
Do you believe he'll do jail time?
If he is convicted, from everything we know now, I'm not prejudging what a judge may do. I think that kind of punishment, some kind of prison time, would be perfectly appropriate.
You are also among a group of senators calling for the FTC to investigate Twitter over the safety and security of consumers. Why?
There is clear need for greater transparency and disclosure here about how Twitter is operating as a matter of public impact and the kind of information and misinformation, as well as outright distortion of potentially what's happening internally, but also the way content modification is being done. I think consumers and the public deserve to know more.
And the public is outraged still about another story, and that, of course, the Ticketmaster debacle and Taylor Swift tickets, the unraveling of that entire system. What needs to happen?
Well, as you know, David, Live Nation Twitter merged a little more than 10 years ago. When they did so, there were agreements called a consent decree as to conditions that would be established about preserving competition and even enhancing it. Why is that important? Well, essentially, the artists, the consumers, the venues all have an interest in choices. They should have choices rather than one seller and being at the mercy of one seller, Ticketmaster, or any other single monopolist. And that's what we have right now in this industry for artists, venues, consumers, one seller. And competition is really important, but is undermined by the fact that Ticketmaster has, in effect, acquired control or outright bought the sponsorships, promoters, the booking agents, the venues. It is, in effect, in control of this industry to the detriment of all involved. And so I think if the investigation shows what I've just outlined as a lack of competition, the company needs to be broken up. In effect, the merger unwound. And that's what I've called on the Department of Justice to do as a result of its investigation. It has an ongoing investigation. Remember that a number of us have called for investigations repeatedly in the past. And so there was a second consent decree, which again, Ticketmaster violated. I think that we need real action here, not just another consent decree or agreement, which Ticketmaster seems to have no way to respect.
Have you been at all satisfied with the response from Ticketmaster Live Nation?
Well, essentially, there's been no response in terms of real action to meet my concerns. As a matter of fact, almost just the opposite. You know, Ticketmaster or Live Nation's principal owner said, well, it's really Taylor Swift's fault. Why? Because she hasn't done enough tours. It's her fault because the demand was so great that our system went down. Well, that's not the problem. The real problem is that they have a monopoly on those tickets. And they decided to hold a number of them back. They decided to cancel the sale. They have been the ones responsible. And that's why we need either really strong enforcement of the terms and conditions of those consent agreements, or, as I've advocated, unwinding and breaking up of this merger.
Yeah, her promoter, AEG, said they had no choice but to use Ticketmaster Live Nation. Senator Richard Blumenthal, always good to see you, sir. Enjoy the weekend.
Thank you, David. Take care.
All right, good stuff. Shauna, what's moving after hours?
We've got three big movers of the week for you, Dave. Salesforce, CrowdStrike, and Five Below. Let's run through them real quick. First up, let's take a look at Salesforce ending the week in the red. You're looking at a drop of nearly 6%. The move to the downside coming after the company's outlook signaled a weaker economic environment, and Salesforce also surprised the street with the exit of its co-CEO, Brett Taylor. He is leaving the company at the end of January. Now, Taylor was thought of as a potential successor to Mark Benioff, who will now be the sole CEO of the company. Wolf Research downgraded the stock to peer perform after more than a decade with an outperform rating. Salesforce closing the week in the red, and you can see right around $144 a share. Another name that's lost some momentum this week, CrowdStrike, dropping just around 11.5%. The move to the downside coming after the company's revenue forecast missed expectations. The weak outlook was due in part to customers delaying purchases, this coming amid a tough macroeconomic environment. 30 analysts cutting their price targets on the stock by an average of about 25%. Two lowered their ratings. Let's wrap it up with a big winner because we want to end on an upbeat note. Five Below soaring this week, up nearly 14%, a third quarter earnings beat, strong full year guidance prompting analysts to raise their price targets on the stock. Jefferies calling the results, quote, robust. They raised their price target to $200 from $175. KeyBank, Truist, Telsey Advisory also upping their price targets. So Five Below, a bright spot here for retailers this quarter, Dave.
Boy, they sure are, Shauna. Thank you. And we're gearing up for a busy week here at Yahoo Finance. On Monday, we'll get readings on the service sector and factory orders. And more importantly, here at Yahoo Finance, we will unveil our Company of the Year. So get your guesses in, folks. On Tuesday, AutoZone, Stitch Fix, Toll Brothers among the companies reporting earnings. On the data front, we'll get a reading on the trade deficit. Wednesday, Campbell's Soup, Rent the Runway, and meme stock favorite GameStop report earnings. It'll be a busy day on Thursday after the close with results from Costco, Lululemon, and Oracle on tap. And Friday, we round out the week with the Producer Price Index and the Michigan Consumer Sentiment Report. So a lot for you next week right here on Yahoo Finance. Coming up, if you're in the hunt for a new job, you might be better off in some states than others. We'll We'll tell you which ones next.
$263,000 jobs added last month, with growth the strongest in female-dominated industries like education, health services, and hospitality. And that's why women accounted for the majority of jobs added in November, making up 62%. Here to talk a little bit more about this, we want to bring in Katika Roy, Pipeline CEO and gender economist. Katika, it's good to see you. So women making up the majority of jobs added last month. But when you take a look at the labor participation numbers, that's a bit concerning and tells a different story. Women making up the majority of the people who left the labor force. How do you square these two dynamics that are going on right now in the job market?
Yeah, I think it's actually, if we look across all cohorts of women, and since the beginning of the pandemic, we actually have 1.8 million women missing from the labor force. And with and when you look at that, we could actually close essentially the ratio of jobs open to folks looking for a job by a quarter if we brought those 1.8 million women back.
So when we say missing, who are they? Where are they? Where have they gone? What will bring them back?
So there's two things that would bring them back. The first is a more equitable workforce. That is beyond pay, actually equity of opportunity. And I'll give you one example. Women are 58% of college graduates, 47% of the labor base, but yet they make up only 8% of Fortune 500 CEOs. So we have this gap in opportunity in the labor force. The second piece is actually equitable skilling. So we leaped forward 5 years in terms of digital acceleration since the beginning of the pandemic. And so the jobs that existed at the beginning don't necessarily exist today. So we need to skill, in particular, women into those jobs.
Katika, another troubling trend, middle-aged men, which by definition, 35 to 44 years old, are missing from the labor market. 89.7% working or looking for work in November. That's down from 90.9% pre-pandemic. Any idea as to the factors that are causing this?
It could be skilling. That certainly could be part of it. But it depends on the match between the jobs and the skills that folks have.
Interesting. The tech layoffs presumably have been hitting a majority of men. Is that going to be reflected in the reports ahead?
It could be, but what actually happens is that women are the last hired, first fired. So while men make up the majority of the tech sector, if you look at the numbers of women, in particular women of color, Black women and Latinas, they are most likely to be affected in terms of the layoffs. And actually, the impact is even bigger because they make up such a small percentage of the tech labor force.
So
and I'll just add one. Oh, well, go ahead.
No, I'm sorry to jump in there. I guess then just looking forward, though, saying that how much worse that gap could potentially get because you still have an aggressive Fed. The Fed is saying that it's not turning, it's not stopping anytime soon. The economy continuing to weaken. So 1.8 million women missing from the labor force, that's likely to climb then pretty significantly.
Yeah, absolutely. And it will continue to decline, just as we predicted that it would when the Fed began raising rates. And so one of the things that we know is that the inflation rate for goods and services targeted toward women is actually twice that of goods and services targeted toward men. So women were actually impacted by inflation even before the Fed started raising rates. And that also impacts women because it's a credit risk to be a woman. We pay higher rates for things on mortgages and car loans.
The pay transparency law, which we're seeing spread across the country, New York, the latest to add that, was thought to at least address this in part. Has it been successful?
Well, I think it's too early to tell whether or not it's been successful. What we know about pay transparency is that it's a first step. It's not a solution, that it is not the solution. So it provides guardrails in terms of being more transparent about what a job pays. But what's interesting about that is there was actually a study done that showed that men actually are more likely to benefit from pay transparency than women. They actually receive about 2x the increase in salaries compared to women.
The last issue I wanted to touch on is remote work, which really helped the participation rate of women because they could work from home, but it's starting to disappear. Offices are starting to want employees to come back to work. What will be the impact on the gender gap?
That's a great question. I think that one of the things that we saw with remote work is certainly does help more women participate in the labor force. There is an issue in terms of whether or not there's actual equity in remote work. That is, there's a bias around being closer in to the office, and you are more likely to be promoted and receive higher performance reviews and performance ratings. So I think that's there's still a question on that.
All right, come back once we get some data on that. Katika Roy, nice to see you. Enjoy the weekend. Okay, looking for a job? Speaking of, Wallet Hub has a new ranking of the best and worst states to find a job. The company looking at factors like job satisfaction, median income, and commute time to determine the rankings. Here are the results. The top 5 best include Minnesota, Colorado, New Hampshire, Vermont, and coming in at number 1, Washington State. Now, the worst states to find a job include Arkansas, Louisiana, Mississippi, Kentucky. Boy, the Southeast always appears bottom 5 here, and the 50th or worst is West Virginia, Shauna.
And now taking a deeper dive into some of those individual factors that contribute to the rankings, Wallet Hub looking at states with the highest opportunity for employment growth. Those states are California, Connecticut, Illinois, Vermont, and Florida. States with the highest monthly average starting salary include Indiana, Washington, Texas, New York, and Virginia. And this one, especially important for you, Dave. And for me, I don't have as long of a commute though. Time spent commuting. Wallet Hub finding that states with the longest commutes are California, Massachusetts, New Jersey, Maryland, and New York. Your state, Dave, you have a long commute. It's not on there though.
Well, listen, I would wager, and I would put any amount of money on this, that my county, Fairfield County, Connecticut, is number 1 in the country. I guarantee you that. But in terms of the state, there's not a lot of commuters because Hartford is the biggest city. But on average, my world commutes about an hour and a half to 2 hours each way, as I do 20 hours a week. So come on, tell me no one commutes more than Fairfield County, Connecticut. But regionally, I think this is interesting because Vermont and New Hampshire, so high on that list. And again, I pointed this out, the Southeast just continues to lag in job creation and economic development. And it would be nice to see something done about that.
Which is interesting because comparing that to the discussion that we had yesterday, just in terms of where people are looking to move, a lot of them are looking to move to the Southeast just because the cost of living is so much cheaper. So you wonder how people are able to do that if there simply is not nearly as many jobs or opportunities, at least from the findings of this study, when you compare that to some of the other states across the country.
Of course, most of those people looking to move to that region, moving to Florida, which continues to perform rather well economically and job creation as well, in part by their tax environment.
And then you also wonder how remote work could potentially factor into this, although more and more people heading back to the office, so not as common as it's been over the last 2 years. All right, well, coming up next, forget cash. Kids want Robux for Christmas. We will tell you all about the new trend. I'm going to learn how to pronounce it when we come back. Cash allowances are out. Virtual currency is in. Apparently, more kids are telling their parents that they would rather be paid in Robux. That's video game Roblox's form of online currency than receive cash for their household chores. Certainly, the world has changed. I never got allowance, so I'm not exactly the best person to weigh in here. Also, my kids are a little bit too young to be playing video games yet, but it's an interesting trend. This was a piece in the Journal, Dave. There was a 12-year-old that was quoted in here saying that if she were to get real money or spend money in real life, she'd have to ask her parents to take her to the store. They would have a say in what she's getting. Now she has control over what she's buying on Roblox. She has a point. I don't know as a parent how I would feel about that, though.
Not great. And I did get an allowance. And allowances really don't exist anymore at all. And part because their money is here. It's Apple Pay, and the financial literacy is my concern here. This is definitely a trend. My kids don't play Roblox, but it's all digital money that they ask for. Typically, my son wants gambling money on FanDuel or DraftKings, but that's a whole nother story. But most of these kids...
Well, that's kind of similar. You could see this.
Yeah, most of these kids do want it in some type of digital currency. And I guess the concern is they don't really understand the value of a dollar. I always felt that you did by holding that money, by having $5 or $10, and by spending it, and realize that a Starbucks actually costs $7. And when you just swipe a phone or when you spend digital money, you don't truly realize what you're spending, the value of a dollar. And that's the larger concern here. Some of these parents like this. Some of them like that their kids they think, learning in this digital space.
I don't know how I would feel about my kids spending hard-earned money on Robux for Roblox, but I guess like you were saying, your kid's spending it on gambling, or wants to at least. I think it does speak to a larger question just in terms of how kids do value money, the changing times right now, the fact that cash is really becoming obsolete. I think you could say that for the younger generation at least. And there was also a case made in the morning meeting that people simply don't give their kids cash because not everyone accepts cash anymore. Some smaller companies only accept credit card, which makes it a little bit more complicated for everyone involved.
A lot of companies cashing in on this Roblox thing. Chipotle, Walmart, Kellogg's, Chobani, Nike, just a few of the companies that have really jumped in on this space. All right, that'll do it for us Monday. A big day here for us here at Yahoo Finance. We'll be unveiling our Company of the Year. A look at one public company that stands out from the crowd. Throughout the day, we'll have full coverage of this one company, including an interview with the CEO to get an inside look about its secrets for success, Shauna.
I'm excited to see who it is. I have a few guesses out there. I don't know if I'll be right or not. All right, well, that does it for us today on Yahoo Finance Live. Be sure to come back on Monday to find out who exactly that one company is. Have a great weekend.